Hi, this is Daniela Cambone, and welcome back to StansberryInvestor.com. Last year, when most investors were watching their stocks plummet, one Wall Street legend had an unfair advantage that was identifying winning stocks with massive upside, like Riot Blockchain before it shot up 10,000%, Digital Turbine before it shot up 789%, and Overstock before it shot up over 1,000%. This power gauge comes from the legendary Mark Chaikin. And right now you can get a free in-depth look at how his power gauge system works. A way to type in any of the 4,000 different tickers and see exactly where the stock is most likely to go next and in any type of market. Simply go to powergaugetrial.com for your free look. Again, that's powergaugetrial.com for your free look. All right, let's get to our segment today. Hi, this is Daniela Cambone for StansberryInvestor.com. Welcome back to our Outlook 2022 series and Happy New Year. So far, stock valuations are well above historical norms, ahead of interest rates from the Federal Reserve. How will the first quarter of the new year play out? Well, please welcome back to the show, Michael Gentile. He is the co-founder of Bastion Asset Management. Michael, nice to see you again. Happy New Year.
Good to be back. Same to you.
We have a lot of ground to cover. Last time you were on, it was a real home run. So happy to touch base with you again. But first, I have a fun fact I want to share with you. CIO Keith Lerner found that going back to the 1950s, when the S&P had a total return of at least 25% in a year, stocks usually rose the following year. The outcome during that 71-year stretch, stocks advanced 82% of the time, or 14 out of 17 instances. The average gained 14%. So is history any indication of how 2022 will play out? Will it be another banner year for stocks?
I think it's going to be tough to lap 2021 for the market. We talked last time Danielle was on the show about tapering. The Fed has started its tapering process. We're 2 tapers in, plus a bonus additional 15 billion that they threw in there in December. I think that's going to be a really hard mountain for the market to climb over the course of 2022. The Fed is talking about tapering and then going into interest rate increasing mode in 2022. Typically, that's a difficult period for the market. So I like history. I study history. I think it can be often helpful in analyzing market returns going forward. But I think this year is going to be a tougher year than that. It's not going to be as easy as people think for 2022 in terms of equity market returns for this year.
A lot to unpack right there. But in terms of forecasts, a lot of experts calling for at least a 20% correction in the stock market. Is that in the cards for you?
I think the tapering process and the interest rate increasing process is a landmine the market's going to have to get around. So far, the market's been very complacent, very trustworthy when the Fed says, don't worry, we got this covered. I think one of the issues that I've been thinking a lot about for 2022, Daniela, is the Fed's been buying 30 to 50% of pretty much every bond issuance for the last 24 months or so since they started this massive quantitative easing program after COVID. What happens when the Fed's no longer there in March? The bond market has not been able to trade freely for years now because of the Fed intervention. Danielle, if you take any buyer of 30 to 50% of everything out of a single security, whether it be real estate, equities, gold, or anything, that's kind of a major impact on the price. So in the bond market, you take the Fed, who's been the whale buyer for years now in the bond market, you take them out of the picture. Bonds then have to trade freely, and buyers like yourself and myself will now be clearing the bond price. You have inflation running at 6 to 7% right now. The 10 years, 1.6 this morning. What would your fair price be for a bond if inflation's running 6 to 7%? If you buy it today, you're signing up to earn -4 to -5% real yields for the 10-year process. So there's a lot of room between where inflation is today and where the bond yields are, and that's a very reckless position to be in as a bond buyer. My first bid would be 8 or 9% on the 10-year treasury if you asked me to put my real money behind that bond purchase. So between 1.6 and a much higher bond yield in the future, that is a very dangerous position for equity markets, for real estate, for bonds. A lot of the asset classes are trading off really low rates. So that's my biggest risk for 2022 is what happens when the Fed is no longer buying bonds? Where does the yield go? And what impact does that have on all asset classes across the spectrum in 2022?
Yeah, I like how you were saying offline when we were talking, the Fed's going to transition from being the buyer of last resort to the buyer of everything.
Right? They've become the buyer of everything, right? They used to be the buyer of last resort or emergencies only, and they hung around this bond purchasing for much, much longer than they should have. And the market's been feasting off these really low rates for years now, which is why real estate's at record highs, equities are record highs, high yield bonds are record highs. But when the Fed removes itself from the picture in 2022, that's the big question we got to get past. this year, and it's starting January, the next meeting, and after that, you're going to see less and less bond buying by the Fed. What impact does that have on rates? My strongly held view is rates are going higher, and as rates go higher, typically assets prices go lower, and so that's why I think the equity market's going to have a bit of a harder time kind of plowing ahead like it has in 2021.
If that's the biggest risk for you, let's talk the lowest risk.
The lowest risk. I mean, I think you'd probably want to be in cash. I mean, it's the safest place to be right now. I think it's a massively under-owned asset, because you look at the margin balances of retail investors, they're at record highs. Everyone's kind of all in on the market right now. So I would argue to have a very defensive posture going into this year. I know I've been cautious for a while. The market's continuing to march higher, but you never know when the party's going to be over. And when the party is over, it's pretty dramatic and swift. Like we saw in 2018, 20% correction in a span of 30 days. Like you saw in March 2020, it was down 42% in 30 days. Then nobody rings the bell at the top. So I think cash is an under-owned asset. I mean, I'm not saying you want to be in cash for decades, but kind of going in 2022, I would get off margin. I'd be in cash, a little more defensive, be able to be a buyer when everyone else is selling, versus today when everyone else is buying and everyone's on margin in the market.
But be able to be liquid, what kind of percentage in cash should you be? How would you decide that?
Depends on the investor. It's hard to give broad-based advice for a measure, but I would say, I would say 20-30% cash would be a good place to be going into this year, and see how things play out. Get through a few tapering, get through the first rate hike, see how the market reacts. You're probably going to get an opportunity.
I was sure you were going to say gold. Where does that fit into your low risk environment?
I mean, gold is another. So cash is completely under-owned. I think gold is equally under-owned. And obviously, your viewers that know me know I'm very bullish on gold, and I remain very bullish on gold. So a combination of cash, gold, physical gold, and silver would be a good place to be, because as I said before in your show, those asset classes are going to hold up a lot better in a downturn. They may not go up, but they're probably going to go down a heck of a lot less than everything else in your portfolio. And that gives you the liquidity and the flexibility to redeploy capital to some of the asset classes that will get hurt very hard by rising rates in 2022.
You've made a name for yourself. You're an expert in the mining sector. Where do mining stocks fit in for you right now?
Yeah, I would say if you look at the market, Danielle, I still believe this. It is in August. I stand by this, that the mining sector is probably the most under-owned and underloved sector by far in the market. You've got the cheapest valuation, probably has the best fundamentals, and nobody really cares to own these stocks right now. So to me, in my portfolio, I'm cashed up. I own physical gold, and I own gold and physical silver, and I own physical gold equity producers and exploration companies. That's sort of where I position myself in 2022. I'm a contrarian investor. I don't like to be where everyone else is piling on to the same trade, because when somebody else fire in the movie theater, everybody runs to the exit at the same time. It can be very, very brutal in those sectors. So I think it's a great place to redeploy capital, to be buying some of these precious metals equities at low valuations when there's no one there, and fundamentals are quite positive for that sector going forward.
I had a great conversation with Lynette Zhang, who was saying that this will be the year the Fed will be fighting to establish or reestablish their credibility. Will they be successful in fighting the inflation beast? That's what you called it the last time we were on. How successful will they be?
I think that's a good question. I think they're going to have to choose between one or two things: destroying equity and asset market valuations around the world, or establishing their credibility. Because right now, it's very clear to me there's a tough choice. That's why they're really trapped, right? The Powell finally came out between our last interview and today saying that inflation was no longer transitory, and that'd be with us for a while, or more structural inflation. So the Fed's job theoretically is to fight inflation and control the money supply, and make sure money maintains its purchasing power over time. The Fed's clearly way behind the curve here. Inflation running at 6-7%, no sign of abating, and yet they're still doing quantitative easing. That makes absolutely no sense. So to me, their credibility has already been dramatically weakened or lost during the last year or so, where they've had their policy so far out of sync with the general public and what their mandate should be. So in 2022, if they want to regain their credibility, they're going to have to raise rates even faster than their Fed dot plots are indicating. My bet is they won't be able to do that, because the market will have a panic attack and be down very, very much from that point. So they start raising rates or getting their interest rates a little bit higher. So that's the choice they have to make: maintain their credibility, do their job, and have equities go down 30-40%, or kind of put their credibility aside and say, our job is really to keep asset prices inflated and keep the market going. That's not their job, but that's what they might choose. That would be a major loss of credibility for the Fed, in my opinion.
Well, if they have to taper faster than they wanted to, how does gold react? How does Bitcoin react? Because gold, we have a track record of how it has reacted in the past. This will be Bitcoin's really first run at this.
Yes. So I said last time we talked that I think gold market's not really going to work until the Fed gets serious about fighting inflation. They've started tapering. I don't think what they're doing is very serious, but they've started the process to get on that tapering chain. Gold's going to reassert its market dominance, I think, Daniela, once the Fed kind of oversteps. So is it the third taper, the fourth taper? Is it the first interest rate hike, the second one? What's the point that kind of tips the punch bowl over and causes rates to rise rapidly and kind of lose control of that bond market or the interest rate yield curve, so to speak? When that happens, equities are going to roll over quite aggressively. Assets are going to fall quite dramatically. At that point, typically what the Fed will do is they'll come back in the market and say, well, sorry, we made a mistake. We went a bit too far. We're stopping interest rate hikes. We're maybe adding some quantitative easing back to the market. That's the point when investors will realize the Fed can no longer control inflation. They no longer have the capacity either choose between massive asset deflation or equity price deflation or inflation. What the market, they're cornered. The market still believes they have the magic wand to get out of this corner. Once the market sees they no longer can get out and that they're choosing between, like I said, equity deflation or inflation, that's when the gold market should really start to assert itself. When you come back to Bitcoin, I've said this publicly, I don't think Bitcoin is gold 2.0. I don't think it's a store of value. I don't think it's a wealth preserver. I think it's a highly speculative instrument that trades like the NASDAQ triple QQQ ETF times 3. If you look what the Bitcoin price has done, Danielle, in the last 3 months, when the equity market's down 2%, Bitcoin's down 8%. When the equity market's up 1 or 2%, Bitcoin's up 4 or 5%. I've looked at Bitcoin's price behavior the last 5-6 years. Whenever the market's in trouble and the equity market is down hard, Bitcoin sells off 2-3 times as much as the equity market. So my view would be that Bitcoin's not going to be a good place to hide when the market starts to roll over. And we'll see what happens on the other side of it. But right now, it trades exactly like a tech stock or highly levered ETF to technology stores.
The thing you bring that up because I've had other experts that say, well, Bitcoin will trade like Amazon. And if that's any, let's say, future indicator, well, it's a good bet to play right now.
I mean, Amazon's one of the most successful companies in the world. It's wildly, profitable and driving sales growth, revenue growth. I think the correlation between Amazon and Bitcoin is spurious in the sense that it trades like a risk-on speculative instrument that's tied to speculative pools of money that roll into technology. So my point is, when the market rolls over, tech's probably going to lead to the downside, and Bitcoin is heavily tied to that group of investors. The same kind of group of investors are speculating on those same kind of assets. And so I really don't think Bitcoin's going to do very well in a downturn. And at that point, we'll be able to see who the true believers are at that point when they've lost 30-40% of their money in Bitcoin.
Housing market, where do we go from here?
All tied to the same question on interest rates. So the market's been feasting off of low rates. I think you're in Canada right now, Danielle, you see what equity, real estate prices are doing in Canada, what they're doing in the US. They've been really, really strong. Again, tied to the fact that the Fed has basically been pinning rates at 1% or 0% for years and years while inflation is running hot, forcing investors into hard assets, forcing them to overpay for assets. So again, if you believe interest rates are going up, you've got to be a little more cautious on real estate. If you believe, like your previous interview had said, that they're going to get really serious about trying to get their credibility back and really try to get a control of inflation, then real estate could be extremely vulnerable. Because if 10-year rate goes from 1.5 to 3 to 4 to 5, what that does to affordability of real estate is extremely negative for the buyers. And therefore, prices will have to readjust lower to allow people to afford to stay in their homes and pay the higher mortgage bills. So I think all these asset classes, Danielle, are all kind of tied together. And they're tied to a rising rate market environment. And so if that's the case, that's why I'm a little bit cautious about asset classes going into 2022, because I think a lot of that's going to be under pressure as the Fed lets rates drift a bit higher in 2022.
You've given us a lot of incredible information here. So to bring it home, for the folks at home who are starting off this new year, and, New Year's can be overwhelming for a lot of people. There's resolutions and they're looking at their finances and they're looking at their life and they're looking at the state of their health or whatever. So it can be a very overwhelming time. But if you, when it comes to your finances, what's your suggestion? How can you tackle it if people want to recalibrate or, just take some time to change what they're currently doing?
Great question, a great idea. I would say if your investors have exposure to assets, if they're an owner of assets, whether it be equities, bonds, real estate, they've probably done very, very well since COVID. It sounds perverse, but since the global pandemic, it's a rough time for humanity. Most asset classes have increased dramatically in value. So if your viewers have made a lot of money in the last 2 years, whatever they're invested in, my firmly held advice for them would be to take some money off the table, cash in some of those profits, take some of your gains off the table and stick it in cash or physical gold and silver, and sort of come out of this big run feeling good about the last 2 or 3 years you've had. Do not get caught up in the cycle of greed that we're in now, which I've made a lot of money the last 2-3 years. I want to make even more in 2022. I've seen so many people in my career make a lot of money and then lose it all in a crash. So the best thing your viewers could do is tuck some of that away, put it in an old school safety deposit box. Don't touch it. Have that discipline not to touch the cash until there's blood in the streets. and they'll feel really good about the last 3-4 years. But most people are going to ride this bubble up and they're going to ride it down. They're going to end up at the exact same place they were 3 years ago, having same net worth they had before the market rose. So it's hard to do, but I would say have that discipline to take some profits, get some cash, stay liquid, and see what happens in 2022.
Sometimes you just got to go old school. Absolutely right. Michael Gentile, Happy New Year.
Happy New Year to you.
Stay warm, stay safe, and come back soon, okay?
Thanks a lot. See you again.
And thank you for watching. Be sure to stay tuned. Our Outlook 2022 will continue with more incredible guests like Michael Gentile. So be sure to stay tuned to stansberryinvestor.com. In the meantime, don't forget to sign up for premier access to content you can't get anywhere else at danielacambone.com. That's it for me. Thanks for watching.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.